with the evaluation of the balance sheet accounts. So far, excuse me, we evaluated the current assets of, cash, but accounts receivable, merchandise inventory, and prepaids. And then we jumped down and we did the current liabilities, accounts payable, and salaries payable. So I wanted to address those first because those were all items that fell under the operating activities. And you'll have to excuse me too today. My throat's not going to cooperate. But if you go back to the information in the problem, let me do this first. I also gave you guys some notes and we went through those. This is last week. So in this first link here, you have a copy of the handout, which is up here on the table. But then we had notes that we took a look at together as a class. I did not copy those for anybody, but this was just some information on the statement of cash flows and the various categories if you need to review that at all. All right, so again, picking up where we left off, which was the evaluation of these accounts. And so our goal is to figure out why cash changed. And cash went from, and we're moving right to left here. So starting over here, this is 2012. So the ending balance of 2012 becomes the beginning balance for 2013. Cash changed by $27,610, but net income was $121,610. So the question becomes, particularly for people that don't understand accrual basis accounting, which would be most non-accountants, well, if net income was $121,610, why did my cash only go up by around $27,600? So that's what this statement of cash flows is going to help to answer. We take that accrual basis net income, the $121,610, and we make adjustments to it to convert it to a cash basis number. And we do that through the statement of cash flows and the various sections: operating, investing, and financing. I think what I said I was going to do today is then we stopped with the current assets, current liabilities. So let's take a look at plant assets. So that's the next account we're going to evaluate. All right, so not only do we have to take a look at the accounts that are associated with that, which would be the plant asset and the accumulated depreciation account that goes along with it, we also have to look at the additional information to see if anything else happened that might be useful. Excuse me. So plant assets, we started off with a balance of $315,000, and so let's do this first. Debit and credits, right? Assets have a normal balance of a debit. Accumulated depreciation is a contra asset account. Therefore, it will have the opposite balance of the plant asset account. So we started off with a balance of $315. That would have been the 12/31/12 balance. And then if you look at the end of 2013, the balance was $460,500. So we have to figure out what happened here. And the reason that I'm just not going to jump and say the difference is because there's actually a couple of things that happen. So we have to, like I said, we have to look to the additional information before we can continue that evaluation. I'm sorry. I just want to get these balances in here first. So accumulated depreciation will start off with a balance of $90,000, and by the next year it was $128,550. So, like I said already, I'm going old school here, using T accounts first, and then we'll incorporate all this data into our Excel spreadsheet. All right, so in the additional information, it says depreciation reported on the income statement for 2013 was 46,500. So basically, that's letter B down there. And that's important because it does help explain at least part of the change in accumulated depreciation. So this gets posted here. Okay, and that's our depreciation for the year. But you'll notice that that doesn't actually balance out, does it? In other words, there was 90,000 in here to start. We're going to debit or credit this account for additional amount of depreciation for the year, but that does not add up to 128,550, so something else had to happen. Okay? That something else is, the information for that something else is at the top of the next page. So we have C and D to address. C and D. All right, so this was B. Take a look at C. C says purchased $165,000 of new equipment, putting $90,000 cash down, and issuing $75,000 of bonds. So that's going to also play into our evaluation of that bonds account a little bit later on, but let's do the journal entry anyway. So we purchased new equipment, that means we got equipment, so we're going to be debiting, and in this case, it just goes into that plant asset account. They have everything lumped together here. So plant assets, we're going to debit for $165. We're going to credit cash for the amount of cash that was stated as being paid, which was $90,000, and then bonds payable. So this will help to address some of what happened with the bonds payable account too. Excuse me. Once I get all my numbers in here, then we'll label them as OI, whatever they are. Okay. All right, so that means that I have 165,000 coming into here, and this was the purchase of equipment. Okay. I may as well throw my bonds payable account up here too while I'm at it. Right back there. Yes. Okay. I said, are you all right back there? Okay. All right. So that explains some of this, but not all of it, right? That still doesn't work out. 105 plus 75 certainly isn't 120, so we'll have to. There'll be additional information a little later. We'll get to it. All right. So the cash component we don't worry about right now. Transaction D said old equipment originally costing $19,500. With accumulated depreciation of $7,950 was sold for $8,000. All right, so there are a couple things going on there. We have to record the fact that we got cash from selling that equipment. So our cash is $8,000. we have to remove the old equipment and its respective accumulated depreciation from those two T accounts, okay? And then if the book value of our old equipment, if book value is greater than what we sold it for, we have a loss. All right, so book value is going to be our old equipment of $19,500 minus depreciation of $79.50. So if I take $19,500 and I subtract $79.50, I already know that that's greater than $8,000 without even really doing the math to down to the dollar there, right? I can kind of just, I mean, obviously, I'm still over $11,000. And I only sold it for $8,000, so I have a loss. All right, so when we journalize that, we have to journalize all of those things. The cash we received, the removal of the equipment and the accumulated depreciation, and then the loss in this case. So I'm going to debit cash. That's the easiest thing to do here for $8,000. I'm going to come back to that, though, in a minute. All right. When I get rid of a piece of equipment, look up here, I got to remove it from these two accounts, right? So if the normal balance of a plant asset is a debit, when I remove a portion or one asset out of there, I have to credit that account. When I remove its respective accumulated depreciation from that account, I have to debit that account. So we're going to debit accumulated depreciation for the amount given, which is $7,950. I have a loss on the sale of the plant asset. So loss on sale, a loss is a debit because a loss is like an expense, by the way. Okay, and since it's Monday, I'll just do the math for you. The loss is actually $35.50. And then I'm going to credit equipment because it's the equipment that I'm removing. And then we call that plant asset. We don't call it equipment. All the plant assets are in that one account. And that amount is the original cost of $19,500. Okay. So how do I know my loss is $35.50? Well, it's whatever I need to make my journal entry work out. But it's technically you're comparing the cash that you got for the sale with the book value. Book value is cost minus accumulated depreciation. And that came out to $11,550. Since you only got $8,000 cash, you have a loss of $35.50. So again, when I'm looking at this count, I'm evaluating. I have two accounts here, right? These two accounts are affected by that transaction, so I need to come over to those T accounts and make those adjustments. So you'll notice accumulated depreciation is debited for $7,950. And this was the sale of a plant asset. The old equipment got removed. Okay. So this was also the sale of, what did they say that was? Equipment, right? Okay. Now, check the math in those two T accounts for me, please. You guys should have calculators. Does that work now? Is 315 plus 165 minus 19.5 equal to 460,500? That's what I need someone to tell me. Yes. So we've explained the change in that account. That's our goal, okay? So what about accumulated depreciation? Is 90,000 plus 46,500 minus 7,950 equal to 128,550? Yes, so we've explained the change in that account as well. Now that we've explained the change in those two accounts, and we've recorded those journal entries associated with them, we need to see if any of these numbers are going to affect our cash flow statement. And the answer quite simply is yes, it will. Okay, so let's start off with this transaction here. We'll just start off with the first one. Plant assets. We purchased plant assets, right? So we got plant assets worth $165, but we did not pay cash for that entirely, right? The cash associated with that transaction was how much? We put $90,000 down, right? Okay, so it's the $90,000. Now I'm going to switch over here to the notes that I gave you. And we're going to take a look at, okay, we're not until I switch over there, I guess. We're going to take a look at that in next section, investing activities. Include those transactions and events that affect long-term assets, most commonly the purchase and sale, right? So we have from selling long-term assets, which we're going to get to in D, but down here, some common cash outflows include to purchase long-term assets. So this is going to be an investing activity, this $90,000, and it's only the 90 because it's just the cash associated with it. That's all we laid out at the beginning, right? That's an investing activity, and anytime cash goes out in investing or financing activities, we're going to subtract it. So that ends up being an I minus, which basically just means we're subtracting 90,000 in our investing activity section because that was a cash outflow, bless you, that was a cash outflow associated with the purchase of new equipment. Now, there's another part to that, the bonds, right? So let's go over here. Okay? Anytime we issue bonds, what does the word issue mean? Sold. All right, so if we sell, we sold bonds, right? Okay. Okay. So, well, let me save that till we get to the next bond transaction. I'm going to come back to that. Let's just stick with equipment for now. So then we have this next transaction where we got cash, $8,000 cash, right, for selling this old equipment. So that also falls under our investing activities from selling long-term assets. So it's an investing activity, but when I sell something, I get cash. So that's going to be an addition or a plus to my investing activity section. Remember, I'm labeling everything first, and then we're going to do the statement of cash flows. So just be patient here. All right, now, we had depreciation too. So we had some accumulated depreciation that was affected here. But what you have to understand is these two accounts netted together and in conjunction with this loss are really, they net to our cash amount of $8,000. So I don't address those separately. What I do need to look at in this account is this amount right here. Excuse me. And if we go back up to our operating activity section, there were three, okay, back down, sorry, not up. Under the indirect method, we had some adjustments that affected net income. And on Friday, we dealt with the current assets and the current liability accounts, and we either added or subtracted those changes to net income. But then we had two other categories, which we're going to actually see examples of here now. The second, items that do not affect cash inflows or cash outflows, like, excuse me, depreciation expense. Expenses with no cash outflows are added back to net income. So this amount right here, this depreciation expense, which got posted here, you can, I mean, it doesn't really matter if I view this as the debit or the credit necessarily, but this is depreciation expense and it needs to be added back to net income. So it's going to go under the operating activity section and get added back. So it's an O+. So I'm labeling all these numbers before we actually do the statement. So that's an O+. Okay, now the loss, we'll find in that third category here, another type of adjustment that affects net income, gains and losses resulting from investing and financing activities. So a non-operating loss gets added back to net income. This is a loss. Just told me it gets added back to net income. because it's getting added to net income. Net income's in the operating activity section, so that's going to be an O plus. Because if you look here, here's kind of where I had the entire formula then for the adjustment of net income to accrual basis, or to cash basis, excuse me, from accrual basis to a cash number. So you'll notice here, look, we add depreciation, we add losses from disposal of long-term assets. Disposal means getting rid of. In this case, we sold our asset, that's how we got rid of it. So I have to add those two, which is why I added depreciation and I added the loss, okay? Now why? Well, very simply, I was kind of giving you guys the why the whole time so far, so let's talk about, well, this is going to reduce net income, right? So in other words, it went into lowering my net income because it's an expense, and expenses end up on the income statement, but there's no cash outflow. So we add it back. Okay, so that's why we add that back. The loss of $35.50, is actually already in the net amount of this cash. So if we don't add it back, it's going to get counted twice. It'll actually be subtracted twice. So we only got $11,500 in, we only got $8,000 cash, and our book value was $11,550. Bless you. So this loss would be counted twice if I didn't add it back. Okay, it would be added twice if I didn't add it back. So that's why I have to add it back. Okay. Where am I at here? Okay, letter E, right? Retired $60,000 of bonds. Does anybody know what that means? Bond is like a debt, right? Or it's not like a debt, it is a debt. So when I retire it, basically that means I paid it off. That's what it means. So if I paid off $60,000 of debt, I need to reduce that account. And typically the way we pay off debt is with our cash. So we credit cash. All right, now, I'm going to post this here, right? So 105 plus 75 is 180, 180 minus 60 is 120. So that explains the change in that account from beginning to end, right? So this is retired bonds. In other words, we paid them off. So let's talk about the bonds account now. Okay, so back to this $75,000 first. What did I get for creating that additional debt, those bonds payable? What was that part? What transaction was that a part of? This one, right? Did I get cash for issuing those bonds? I paid cash and I issued bonds. So it's like, if you think of it this way, when you buy a car, sometimes you make a down payment and then you take out a loan for the rest, correct? Right? So that would be like a debit to car, a credit to cash, a credit to notes payable. It's a very similar transaction, only instead of borrowing money from the bank, you borrowed money from your investors. So we call that in the form of a bond issuance. So you got a plan asset, you made a down payment of $90,000 cash, but you borrowed money from your investors to cover the rest of that plan asset. Does that make sense? Okay, you didn't get cash for that bond issue, did you? You issued bonds for equipment. Oh, this marker. You issued bonds for new equipment, right? This isn't much better. Okay, this involves, you didn't get cash, so it's not going to go in our cash flow section. However, eventually, you got to pay off those bonds. And what are you going to use to do that? You're going to pay off your debt. What are you going to use to do that? So eventually, it's going to affect your cash, just not right now. This is one of those things that's going to. This is one of those things that's going to go into our non-cash investing and financing activities section. So we just have to talk about it. This is called a non-cash investing and financing activity. We're going to have to talk about it a little later. All of my markers stink. Okay. So that's why I didn't want to address this one just yet. I didn't get cash for these bond issues. I got another asset. I got equipment. And so it's not an inflow of cash. That's not an inflow of $75,000. It was additional plan asset. I paid out $90,000 towards the purchase, but I issued bonds. Eventually that $75,000 will impact my cash flows when I have to pay it back, just not right now. Okay? This $60,000 of bond retirement, I did pay cash for that. So that is definitely going to be, let me switch back over so you can see my notes. I'm going the wrong way again. Okay, here's the financing activity section. Okay, hold on. I want to make sure. Yeah, I don't necessarily have it listed there specifically. I honestly couldn't remember if I did or didn't. However, we have from issuing notes and bonds as a financing activity. So when you repay those, it's also going to be financing. So this $60,000 is going to be. What, didn't that marker just work like 2 seconds ago? A big old F minus. It's like someone's grade, huh? All right, so my marker's straight up here. I can finish this. So you have to be willing to kind of go back to those notes and, look at different categories where things go. We're not even done yet, but I mean, so far we got a lot going on here. So, trying to keep track of all of our O's, I's, and F's that we have labeled, not easy, but we'll get there. All right, so we're at transaction F. Transaction F says declared cash dividends of $64,000. So it may be a while since you've done a journal entry for cash dividends, but when you declare them, that's different than when you actually pay them, unless you're paying them on the declaration date, which isn't something that necessarily happens that often. But in this problem, what I'm going to assume is that we're just going to pay the cash dividend, because I think the problem wants us to actually view it like that. So I would rather that say paid cash dividends, but whatever. Anytime you declare, and if you even want to write on there paid, I'd really feel better if you wrote paid where it says declared. When you pay cash dividends, you have to have a sufficient amount of retained earnings to do so, okay? So in this problem, we're simply going to debit retained earnings for $64,000. They don't give us any other details, so this is kind of what I have to go by. We're going to debit retained earnings of $64,000 and credit cash. But I would really prefer to see that word payment there. Instead of declared, but that's a minor technicality. Because cash did go out, and this belongs under our financing activities, we're going to label that F minus as well, because that's going to reduce the available cash that we have. And again, if I go back to my notes, it'll say some cash outflows include to pay withdrawals by owners. You can kind of think of a dividend as a withdrawal from the owner. Okay, last but not least, and we can get to see how this works. Issued 1,500 shares of common stock at $27 cash per share. So what's the word issued mean in accounting? It means sold, right. Okay, so we sold our common stock for $27. Bless you. If we go back to, bless you, sound like me now. We go back to the liabilities section, or stockholders' equity section, you'll see that common stock is listed at $20 par, right? I need to know that for this particular transaction because I'm issuing or I'm selling my shares for a price that is greater than par value. So I want to debit cash, and the amount of cash that I'm getting is 1,500 shares times $27 per share, which when I do the math, I get 40,500. Somebody just wants to double check my math, that would be great. I'm issuing, or I sold common shares, so that's going to increase my common stock, 1,500 shares times $20 par, which comes out to be 30,000. I need a calculator for that one. And then the difference, the 10,500, is that paid-in capital in excess of par, anything extra above par. Okay. Hopefully you're all taking notes on this because you're going to end up having to do a cash flow statement on your own at some point when you get to those model building problems. So this one's pretty simple though, as far as the common stock and the paid-in capital, what we're getting. This cash amount is an amount of money that we're getting because we sold shares. That falls under financing, and it's going to be a plus because we've got a cash inflow in that case, not a cash outflow. So I really picked apart, the current liabilities, current assets, current liabilities, and some of these other accounts. And then, let's take a look just the common stock account. The only two T accounts that I really didn't look at was the common stock and then the additional paid-in capital. So let's do that though, because we want to make sure we can account for all of the changes in those accounts. I'm just running out of room here. I'm going to put common stock over here. All right, so, and then retained earnings as well. So common stock had a beginning balance of 210, right? On 12/31/12. And then at 12/31/13, according to the information in the problem, common stock had a balance of 240. Well, right? We already accounted for that, didn't we? This is part of that. This is part of the $40,500 cash. So we issued shares, additional shares, right? So we already addressed that. The additional paid-in capital account, okay? Let's see, had a balance of 22.5 at the beginning, or 12/31/12. At the end, it had a balance of 33,000. And if we post that transaction, we credited additional paid-in capital for 10.5, and that was from those issued shares as well. So we accounted for everything in that account too. No questions there. 30,000 plus 10,500, that's the total cash we got. And because these transactions involve debits or credits to cash, we just deal with the amount of cash that we got, but it does explain the change in that account. The only other account we didn't look at is retained earnings. Okay, so retained earnings has a normal balance of a credit. Retained earnings had a beginning balance of $171,900. or at 12/31/12, and then 229,510. Okay. Who can tell me what two activities, transactions, whatever, affect retained earnings? Two things that happened in this list. So we come down here to the bottom. Two things that affect retained earnings. Do you see one of them in the list? Under additional data on that page. Retained earnings means money that, earnings that you keep. So doesn't net income affect retained earnings? So if you think about when you do your financial statements, you do the income statement first because net income then goes to the statement of retained earnings. So net income will increase, right? This is net income for 2013. Okay, but 171,900 plus 121,610 is not 229,510. What's the difference? What am I missing over here as a debit? Does anyone know? Let me turn the page so you can see the list of items up here. Which one of those affects my income? We add that income from retained earnings, but we subtract something else out. If retained earnings represents earnings that you keep, which of those items in C through G represents earnings that we distribute to our shareholders? Dividends, right. So dividends, look, over here, right? What did I debit? Right? I debited retained earnings. Now, I never put a journal entry up here for net income because I don't really have everything I need, technically, for that journal entry. But net income, we would close our revenues and expenses out, and retained earnings would have got credited in that journal entry. But I don't have all those revenues and expenses, so I didn't put that up here. But dividends, oh my goodness gracious. Now does that work? It's 171,900 plus 121,610 minus 64,000 equal 229,510. It sure does, huh? All right, so it's kind of a lot of just getting ready before we actually can do much of anything. Okay, so let me just talk a little bit about this. The statement of cash flow spreadsheet. All right, so the reason I like to do the T accounts and I like to put all the journal entries up here on the board first so that you kind of have them on paper before we try go plugging numbers in here is that, see, there's a column here for debit or credit. So what we have in this worksheet is we have the beginning balance of all of the accounts that we just talked about, the 12/31/12 balance. Then over here, we're going to have the ending balance. So what we want to talk about is what happened to that account that caused the change from here to here. So this column has those beginning balances. This column is going to have those ending balances. We're going to have to plug in formulas. So for example, let's take a look at cash. Okay? Cash started out with 39,600, and I don't have it up here on the board right now, but at the end, cash was 67,210. So that's obviously what you expect the answer to be here when we plug in Formula 1. But then you have to know how the debit and credits work, right? So the normal balance of cash is a debit, right? So this formula is going to be 39,600 plus additional debits minus credits. Does that make sense? Because debits and debits we add, right? Credits and credits we add, but debits and credits we subtract. So this would be 39 plus this column minus this column to give us that solution here. However, we need to add our debits and credits in here. So those journal entries that I've been giving you, we actually need to input them. We need to input them somewhere. So, I'm dying here. So, for cash, for example, let's just do this one so I can sort of demonstrate. And as you scroll down here, when you get to the credits, look, this format lists all the debits first, so that your account formula over here, and I'll do formulas on Wednesday. The account formula over here is going to be this plus this minus this for really for all of these, right? But when you get to credits, right, this is a credit balance. So this formula here is going to be this number minus debits plus credits. It works the opposite way then, right, for a normal credit balance. And then what you have to kind of realize too is we have to insert all of these different activities that we've been labeling either operating, investing, or financing. Here's a section for our non-cash investing and financing. And here what we're trying to describe is the change in cash. Okay? What we're trying to describe is the change in cash. So let's just do one thing. Let's just do this first formula here. Okay? I'm going to do one formula for now. So this formula is going to be equal to B17 plus D17 minus F17. Can you guys see that? My markers have died for the most part. B17 plus D17 minus F17. Okay? So formula number one is equal to B17 plus D17 minus F17, because that's the way we balance T accounts. We add debits. If you have a normal balance of a debit, you subtract the credit. Now, obviously, the number is going to be the same because I don't have any numbers in my debit and credit columns. Okay? So I am going to do one transaction here with you. So the first thing that we want to do is we want to identify the fact that my cash has changed. So actually, I'm going to label this transaction A since I addressed it first. Okay? Cash did what? Cash went up, did it not? Look at the T account for cash from the other day. By how much did cash go up? $27,610. So I'm going to enter that right there in the debit field. Look what happens to my account balance. Does it go up to $67,210 like it's supposed to? Okay. If I have a debit, but I need an opposing credit. So this is where sometimes things get a little confusing. All right. So I'm going to come down here, and next to my change in cash, and like I said, this gets a little confusing for now, but just bear with me. I promise it'll make sense once we get it all in here. I'm going to label column E. I want to label that A because I need 2 A's, 2 B's, 2 C's, 2 D's, so on and so forth, or at least the minimum of those. And I'm going to insert that same number, 27,610, in my change in cash in column F. So that goes in column F because I already have a debit over here. My cash went up, right? But I do need a credit. And this doesn't make a whole lot of sense just right now, but I promise you it will once we get the rest of this in here. Transaction B, let's just do that one real quick so I can show you how that works because I still have 3 minutes. So for transaction B, that's going to be accounts receivable. Look at your T account for accounts receivable. By how much did accounts receivable? I know it increased. By how much? $9,035. And if you look at your T account, didn't we debit accounts receivable for $9,035? What is the treatment for an increase in a current asset account, though? What do we do with that? What section does it go under? What did we label that $9,035? Operating, and did we add a plus or a minus? A minus. So watch up here. So here's the debit, right? That'll change that. When we enter the formula, that'll change that. But down here, we're going to come under operating activities, and we're going to call this increase in accounts receivable. And because I debited accounts receivable, I need to credit it here because a credit to accounts receivable, or a credit, is going to indicate that we subtract it. So 9035 over here. Okay? This operating activity section, there are formulas in here. It is set up to add debits and subtract credits. That's what it's set up to do. Okay? So that's why I wanted to do kind of old school first. I think it's easier to understand this particular format before we start trying to plug in debits and credits everywhere. So really what this is down here is this is the treatment. This section is the treatment. An increase in accounts receivable, we subtract. That's why it's in the credit column, because we reduce assets by crediting them, all right? Okay, so save that. To your desk, or not to your, I'm saving mine to my desktop. You save it to your folder. We will pick up with that on Wednesday. Hopefully we finish that up on Wednesday. There's a lot going on there. So try to review that, please, before, if you have questions, feel free to ask. But go through some of those transactions again. Make sure you understand where all of them come from.
Wow.